This is the Millennials in Multifamily podcast, brought to you by Kronos Investment Partners. We interview industry experts to unlock key information that will help young professionals break into the multifamily world in order to create long-term and short-term wealth. If you enjoyed the show, please head over to iTunes and leave a rating and written review so we can reach more listeners.
Hello and welcome to another episode of the Millennials and Multifamily podcast. I'm your host, John Stober, and today I have the pleasure of interviewing Candace Pilgrim of Apollo Capital. After graduating from Mississippi State University, Candace started a Ph.D. program in immunology before realizing that was not the career path for her. Instead of finishing the program, she started an electronics wholesale company that was at one point the largest in the entire state of Alabama. Like so many other successful business owners, she is investing the profits from her business into cash-flowing apartment buildings and has been structuring her deals not as syndications, but as joint ventures. Candace Pilgrim, thank you so much for joining us on today's episode of the Millennials and Multifamily podcast. Could you give us and our listeners a little bit more of a background about yourself and how you got into this business?
Absolutely. So I'm from Mississippi originally. I attended Mississippi State University in biochemistry and molecular biology and microbiology, 2 bachelor's degrees. And then I actually moved to Birmingham, Alabama to work on my Ph.D. in immunology, but realized that wasn't the career path I wanted to take. So left that program, never actually got the Ph.D., but decided that I wanted to kind of take my own path. So at that point, which was about 9 years ago now, I opened an electronics wholesale business where we basically would buy overstock from cell phone stores, and then we would sell to distributors or exporters. Primarily, they would export to other countries that had a supply shortage in those electronics, primarily iPhones. So that's what I've done for the last 9 years. Built that company to the largest wholesale company in Alabama at one time. There's a lot more competition now. But a few years ago, I realized we had done well with that business and needed to place some capital. So that's what initially got me into multifamily. I started reading a lot of different, investing books on what direction I wanted to go. Played with the stock market for a good year and realized that I was going to go crazy and lose my mind if I kept doing that. So swing trading, day trading, it all just takes too much time, and it just wasn't for me. So I ended up selling all of our portfolio back in early 2018 and focused on multifamily. I love multifamily because it is, in my opinion, one of the most recession resistant asset classes, and is also scalable. And that's what we needed at the time. We didn't want to buy one single family home at a time. We wanted, to just jump in head first and invest our capital. So at that point, we passively invested in 3 deals first as limited partners. And those are in Georgia and Florida and Texas. And we also kind of accidentally bought 2 single family homes and renovated them and rented them. And we still have those today. But then after that, starting early 2019, January, is when I entered into my first multifamily joint venture deal, which was a 96-unit property here in Birmingham, Alabama. And then after that, in August 2019, my husband and I bought our 40-unit property in Birmingham, which is our big project. Still working on repositioning that asset because it was a major overhaul. We had about a $12,000 per unit business plan there to reposition that property and raise the rents. And we're a little over halfway done now, and it's doing really well. And then last month, we actually bought a 30-unit in Charlotte, North Carolina with 2 joint venture partners that are really good friends of mine. And so far, so good on that one. So that's kind of where I am and how I got here. If you have any other questions about that, let me know.
No, that's incredible. It sounds like you've grown, pretty large in a really quick amount of time. So you said you bought 2 single families, but that you wanted to invest in multifamily because of the scalability. So now that you've done both, what have you noticed? What are some actual examples you found that make multifamily more scalable than those single family properties that you have?
Well, one thing I would definitely say is just off the bat noticeable is whether you buy one single family home or, just say a 40 unit property, the time it takes to go through that inspection process and the closing process and, everything that goes into that and analyzing the deal, it's like it does take a little bit more time for a 40 unit, but it's not drastically different. So it takes a lot of time to close single family one by one by one, where if you can just buy 40 units at one time, there's not that much more time that goes into it, but you can jump into a lot of assets very quickly. And obviously there's a lot of benefits that go along with it. One roof, if you're renovating 40 units, you get a bulk discount on rehab versus one at a time. So if you build those relationships with the contractors at an apartment complex, you'll find that you'll save a lot of money long term versus just trying to scale up by one house at a time. You're instantly what's the word I'm looking for? You basically achieve that bulk for the contractors immediately rather than over time.
Mm-hmm. And then since you had the wholesale electronics business, did investing in larger assets just allow you to place more capital quickly into something?
Yeah, that was the main reason that we started with multifamily, was because we could place a lot of capital more quickly and achieve that instant cash flow, because we didn't really want, $400 a month cash flow per single family property. It would have taken us too long to get where we wanted to go, which was the financial freedom.
So then you invested in 3 LP deals. So why did you decide to invest as a limited partner as opposed to just buying your own properties from the get-go?
We wanted to learn from that. So, I don't know if you're in any LP deals, John, but how they send out, that most operators anyway will send out, monthly or weekly updates depending on the deal, and they'll have Zoom calls where everybody can get on, and and you learn from operators that way, especially the good ones that really involve their limited partners. You'll learn a lot from the operations side and how they asset manage, and you'll just get a better feel for trends and what they should be, and renovation costs and what that should be. And the more of those numbers you see over time, the easier it is to formulate a business plan on your own. So that's why I did that.
So how did you vet those sponsors before investing in their deals?
I actually met 2 of the 3 sponsors at conferences that I attended. So, once you've met someone in person, I get a vibe normally from people, and I'm sure most people do. And, then once you get that vibe and you have that trust factor, then, obviously you would also do your vetting with background checks and ask around and check out their past deals to make sure that, have they gone full cycle on a deal before? How did that go? What kind of returns did they provide versus their pro forma? So, I did all of those things as well, but it really came down to just who did I trust? And then obviously I vetted the deal itself too, to make sure that their business plan was possible and reasonable.
Mm-hmm. And then so I noticed you had a lot of ologies in your college degrees when you first started talking. So I'm assuming you're pretty analytical. So were you underwriting their deals yourself to make sure they penciled out from your perspective?
I did, maybe not, to the depth I would if I were going to close the deal myself or offer on the deal myself. But ultimately, there's only so much underwriting you can do without understanding a market.
Right.
So the 3 markets that I invested in were not my target markets at the time. I didn't live in those markets. So there were some things that I did trust the operator on, but, at the same time, there were some things that I could verify or at least make sure it was reasonable based on CoStar reports that were provided to me on, past rent growth and, certain factors I could verify. But yes, I did.
So what were those things that you were able to verify?
Well, like one thing that I'm sure affects returns the most would be your exit cap rate.
Mm-hmm.
So one thing that I remember looking at even back then when I was investing was their exit cap rate to see if it was reasonable. So I verified that based on a CoStar report of recent sales to see what the cap rate was at the time. And then I also looked at historical cap rate volatility. If you pull an underwriting report for a property on CoStar, you can look at the cap rate by year. And that's one thing I always love to look at. In 08, 09, what did the cap rate do? Did it spike to 15% or did it only go up a couple of points?
Mm-hmm.
So even though I wasn't super familiar with those 3 markets, I could still obtain some of that data from the CoStar reports.
Mm-hmm. And then so you went from limited partner to you started buying your own deals in joint ventures. So could you tell us about that first deal and what that transition from LP to active investor looked like?
Yeah, so the 96 unit property was technically my first joint venture deal in multifamily, but it was kind of a blend between a limited partner type deal and a super active type deal. So capital was my main goal. I mean, my main role, I guess you would say, in that deal. But, we did have meetings at the property and went over the business plan. And I did have voting rights and the say so in certain things, but it's not like I was the lead sponsor or whatever you want to call it on that deal. But my 40 unit property, I would say that was where I really dove in head first, because my husband and I purchased that ourselves with no partners. So I had to do everything from start to finish on that deal, from the acquisitions all the way to the closing, all the way to executing the business plan, project managing, the rehab. And that's where it was like my crash course in multifamily, and that's where I really learned a lot.
That's awesome. Could you tell us the story behind that 40 unit, how you found it? What did the numbers look like, if you're comfortable saying that?
Yeah, sure. So originally, it's kind of a funny story. Originally, I first saw the deal on LoopNet. I didn't buy it from that seller, but that's the first time I was exposed to the deal, was on LoopNet. I made an offer on the property, and this was early 2019. Yeah, like January 2019 or February. I made an offer on this deal. The seller and I could never come to terms on the price because they were just wanting too much for it. So after a lot of back and forth, I ended up walking away from it, and I just thought, well, I forgot about it. I thought I wouldn't get it, even though I really loved the deal. I just kind of let it go because I was going to stick to my guns on the price, and not overpay. Well, then about 3 to 4 months later, I got a call from a broker. And the broker knew, this was a broker I had a pre-existing relationship with, knew very well. He knew that I was bidding on that deal previously, even though he wasn't the listing broker. He knew that I was bidding on it. And he knew I wanted the property. And he said that he buys multifamily as well. So him and his partners actually got a whole portfolio of properties under contract in that submarket. My 40 unit deal as part of the portfolio. And he said that the 40 unit deal needed the most work. Now, obviously, like I was saying, it was a major overhaul. And the other properties in that portfolio were stabilized deals, turnkey type, which is his investment strategy, is to buy turnkey stuff. So he asked me if I would like to buy that 40 unit. He wanted to just flip it to me like immediately after they closed. He asked me if I would take it for the price that I originally wanted it for. So he was able to get it under contract on a per unit basis for $32,500 a door. And then he sold it to me for $33,000 a door, basically just a cushion to cover some of his due diligence and closing costs on it. So he didn't make any money on the deal, but $33,000 a door was my original offer price. So it worked out great for both of us. I was able to take some of the capital requirement off of his plate. He didn't have to bring as much capital to the table. And then at the same time, I do all the heavy lifting, and he can just take his stabilized turnkey deals and run with them. So it was a win-win for both of us.
Yeah, lucky him.
Yeah.
So then you said it was a pretty heavy lift. So what does the rehab look like on that?
So the exterior actually didn't need a whole lot. All we had planned to do on the exterior is just some basic landscaping and some paint, trim paint, and a few other little items like an enclosure around the dumpster and whatnot. But the main rehab was with the interiors. There was a ton of deferred maintenance on the interior of the property, a lot of doors needing replaced, all the appliances pretty much. There's really nothing that could even be kept with the appliances. The countertops most need replacing or a lot of work. It was basically just a classic situation of a 70s property that had never been touched or never been renovated at all. It was classic 70s type interiors with super gross carpet that you wouldn't even want to walk on. So the class of tenant came with it. Obviously this is a B class area, but because of all the deferred maintenance, they were getting the worst possible tenants because no one wanted to live in a place like that. So our plan for the property was to go in on the interiors. We did everything pretty much that you would typically do, plus add washer and dryer hookup. So we went in with the luxury vinyl plank flooring, the two-tone paint, new black appliances, tile backsplash, replace doors where needed, which was about half the doors per unit needed replacing. And washer and dryer hookups was the big thing. We had to move around some walls and accommodate for that because there wasn't a neat little space for it in every unit. Some of them we had to really get creative.
Mm-hmm. So it's definitely not, just like kitchen renovations and interior renovations. It's some pretty heavy duty lifting. Is this your first time really managing contractors?
On this scale, yes. We actually built a house in 2017. My husband and I built a house, like a custom home. So we ended up learning a lot from that process. We actually had a builder because it was required by our city, but our builder ended up being awful and not doing anything he was supposed to do. So I was kind of forced to learn a lot through that process. And I was in direct contact with all of the subs at that time. And, I paid them directly. So I learned a lot about everything then. And then obviously our 2 single family rentals, we did a total renovation on those, and I managed that. So I had a little bit of knowledge, but nothing compared to what all I've learned with this 40 unit rehab.
Yeah, I want to go into that. What are some of the differences you've noticed between managing something this large versus, just a single family house?
Well, it's very similar, just on a larger scale. But one thing that I would say is tricky is trying to stay within the deadlines, because not only are you coordinating all these contractors for multiple units, we've been turning 5 units at a time. So it's not like we're turning all 40 at one time. We've been turning 5 units at a time, but even with that, not only are we coordinating all the subs for those 5 units, but we're coordinating with property management for lease up. So that's one thing that I found kind of challenging that I didn't think would be challenging. We'll have our property manager say, well, this resident wants to move in on this date. Okay, well, let me tell the subs to make sure, I'll try to coordinate them. But as you know, something always goes wrong to push that date. Well, then they've already signed a lease for that date. And then we have to, it just gets a little tricky coordinating. So one thing we did to try to combat that was we all got on a Slack channel. So like we have channels with our property management team and our maintenance guy, and we have a channel specifically for rehab within our Slack that we post updates on, when each unit will be ready. And then we have a leasing channel where our property manager will post, if we have any leads that we think are going to be converted to leases, we will coordinate on dates, try to get ahead of that and make sure we meet deadlines.
So now that you're in it, if you were to underwrite the same deal again, is there anything you would change during the rehab and your assumptions as far as how quickly you're going to do it, how long it's going to take to lease them up?
I don't think I would really change anything now. We pretty much have met pro forma on it. So when I originally underwrote the deal, there was a lot of meat on the bone, which you could tell from, we pay, like I said, $33,000 a door. Well, these rent for $795.
Nice.
So there's a lot of meat on the bone, really. So because I had so much wiggle room, I was extra conservative with our lease up and renovation schedule anyway. Only thing I would say is, I would have added more of a cushion in the rehab budget, because we have had a few things come up that were unexpected. So we will go over budget a little bit with the rehab, but we had reserves we could use. And I have personal reserves. Like I said, it's my deal. It's not like I have investors. I could always just put in more money if I had to. But that's one thing going forward. I would underwrite for a more of a cushion in that rehab budget. And I would also underwrite for greater CapEx reserves per year, rather than that typical 250 to 300. I've learned over time that you really need to look at the property and see, when has the roof been replaced? How many AC units might need replacing? And kind of average that backwards over the years to see how much CapEx reserves do you actually need. Don't just arbitrarily throw in a 300 a unit a year like a lot of people do.
Yeah, I think that's mostly just because that's what your lender usually requires, some sort of reserve account.
Right.
So are you planning on fixing this up and then flipping it, or is this like a BRRRR strategy where you're going to hold it for the long term?
Our original business plan was to either take out a supplemental loan around the 12-month mark, or to refinance it around the 2-year mark to agency.
Mhm.
It just kind of depend. We had multiple potential exit strategies for it. We do want to hold it long term, 7 to 10 year hold. But as far as pulling capital back, that was our initial plan. Now with COVID, I don't know what our refinance might look like, but we did get a loan modification with our lender, which is a local bank. And we were actually able to bring our rate from 5.5% to 3.5%.
Wow.
Yeah, and we also I had a 6-year term, and we were able to get that term extended to a 10-year term. Plus, they tacked on an additional 18 months of interest only. So, given the amazing loan terms we have now that our lender was able to do that for us, I doubt we'll be refinancing as planned. We might take out a supplemental with the local bank because they do that, but
Mhm.
as far as a refi, we're cash flowing so wonderfully now. I think I'll just stay put.
Are you struggling to understand how to underwrite multifamily properties? Hi, I'm John Stober, and I completely understand your problem. I thought underwriting would come naturally to me due to my background in finance and accounting, but I quickly found out that there aren't a lot of resources that cover this subject. I had no idea whether what I was doing was right, wrong, or just original. I don't want you to have to pick up little nuggets here and there like I did. So I wrote an ebook called How to Analyze Big Apartment Buildings and Make Them Feel Small that puts together all the pieces of the puzzle. We're also giving away a deal analyzer with the ebook, and they're both completely free. Don't wait as long as I did to start chasing financial freedom. Go to bit.ly/underwriting ebook and get your free copy today. So do you think that's an advantage that doing a joint venture has over being a general partner in a syndication, is that because you don't have investors, you can hold on to this as long as you want, as opposed to just buying it and flipping it?
Yeah, absolutely. Not having investors to answer to or to, it's important to stick to a business plan. I get it, like even without investors, but it's just the flexibility of knowing it's like my decision, or in the case of a JV, my decision and my partner's decision. That's why, I'd said it's so important to make sure that you're on the same page with your partners, with your, your hold plan or your business plan, your exit strategy. But yeah, having investors to answer to would change a lot of things because they're expecting their money back at a certain year. And, you just have to take that into consideration, especially when you're underwriting the deal, whether it's going to be a JV or a syndication.
Mm-hmm. So do you have any advice for making sure that you do select the right partners?
Yeah, definitely. Yeah, trust but verify, as you hear everybody say. If you get vibes or intuition, go with it for sure. I've learned that over time. And I would say make sure you're on the same page with not only your morals, but your vision and your goals and just where you see yourself in 5 years, and your ambitions and your motivations. Just make sure you're on the same page, because one thing you don't want to happen is you don't want to partner with somebody who is so money hungry. They're like the slumlord or whatever you want to call it. Whereas you're wanting to make the place a nice place, and you want to spend the necessary money to take care of residents. That doesn't make a good partnership. So you just want to make sure. That's just one example of how your morals or your visions would not align. So like I said, trust your gut and just make sure you thoroughly vet partners before you jump into something, regardless how amazing the deal may look. The partnership aspect of it is so much more important than just how great the numbers are, in my opinion.
Okay, so you went from the 96 unit to the 40 unit, and then you said you have a 30 unit in Charlotte. Mm-hmm. So what's the story behind that one?
So the 30 unit property, my partner, Harry Chatlani, he actually found that through a broker relationship. And then Harry brought it to me and wanted me to help him, look at the underwriting with him to determine if it's something we might want to pursue. He's a lot more familiar with the Charlotte market than I am because he has friends and family there. He's actually planning to move there soon. So, we looked at it together and it was a home run deal. So we called Matt Rose to see if he wanted to partner with us and split it 3 ways. So we did. But it was interesting story behind that deal. So the situation was, this guy, his name was Ernest, so I'll just call him Ernest, not the Ernest a lot of us know in the multifamily space, not Ernest Harbin. Different Ernest, none of us know him. Anyway, so This guy, Ernest, he was a single family buyer in the Charlotte area, owned a lot of single family homes. He wanted to dip his toes into multifamily. So he was driving for dollars and cold calling owners. And he actually called the owner of this 30 unit. And this 30 unit, definite like mom and pop, classic mom and pop situation. They had the properties built in the 80s, have managed them and owned them ever since. Self-managed, didn't do a good job of it, typical situation.
Right.
So Ernest calls them up and gets the deal under contract, didn't know what he was doing. So his lender, the lender he had for the single family homes, which is a credit union, that lender put him in touch with a buyer's broker to help him through the process. So they linked up. Well, Ernest ended up not being able to close the deal because he had some doctor investor or something that like flaked out at the last minute. He couldn't close. So then the buyer's broker that got involved in the deal said, well, I know somebody that might buy it now that you guys are interested in selling. And that's when he contacted my partner, Harry. So it was a true off-market type situation with a mom and pop seller. They didn't even have a T12 to give us. So it was interesting. It was a fun deal.
Okay, so how do you underwrite a deal that doesn't have a T12 in it?
So we got their tax returns first. We actually got a reconstructed P&L from them later in due diligence. But before we ever made our offer, all we had was their last 2 years tax returns or Schedule E's that we based our offer on. And it was a pretty easy deal to underwrite anyway, just because in this situation, the residents pay all utilities, including trash pickup. They have their own trash can, which is unheard of almost. So with the residents paying water, sewer, electric, and trash, I mean, we didn't, and it was 100% occupied property. So we knew that our utility expense would not be, we didn't really have to even guess because you just put a little bit in there for vacancy throughout the year and you're done. And then obviously taxes and insurance, I don't go by that actuals anyway. I go by what I think it's going to be upon acquisition. And the other little items, landscaping and property management fee and all that were pretty easy to peg down. So from an expense standpoint, it was an easy deal to underwrite. From an income standpoint, I based it on average rents on the rent roll and looked at their tax return and just kind of had to trust them a little bit that they were actually collecting the rents they said they were collecting.
So you mentioned earlier that it's hard to underwrite a deal that is in a new market that you're not familiar with. What type of insights do you need to have on your market to really be able to dive deep into that deal?
I think the most important one is rent growth because, if you miss that one or rent comp, current rents versus actual rents. So rents in general, if you miss that one, it could change the whole deal. So, one thing we did was we actually drove to Charlotte and we toured this was pre-COVID, right before COVID. We toured all of the rent comps of the subject to get a better feel for our rent bump potential. But even, not just doing that, but what made this deal so easy to underwrite was 7 of the units out of 30 had already been leased for $850, which was our rent premium. The average rents were $700. If 7 units had already been leased with no renovations, it proved the concept right there that we could go from the 700 average to the 850 when 7 of the units had already been leased, to qualified residents. So we didn't really have to dive as deep into the rent comps as I normally would, but we did tour like 4 different rent comps when we were there in Charlotte. But beyond pegging that market rent, we looked at the rental growth rates to see what we would underwrite for going forward, like organic rent growth.
Right.
And then obviously, we called tax assessor to make sure we pegged that property tax number correctly and got our insurance quotes. All that's market specific, but it's very easy to obtain those figures for underwriting.
So do you have any advice to when you first get the deal to quickly underwrite it? Because you're in Alabama, that deal's in Charlotte. You're not going to drive out to Charlotte or fly out to Charlotte to get rent comps. What did that first 15-minute sniff test look like?
Well, one thing, I do a couple of sniff tests, I guess. One thing that I like to look at is your purchase cap on actuals versus your interest rate on your debt. So I like to see a spread there, of at least 3 to 4%. It just kind of depends, I guess, on how much of a value add play there is on the deal.
Right.
And then also, like for single family, you have the 1% rule. Well, I kind of like to do like a 1.25% rule for multifamily. Then that's just from a high level. I mean, if it's anywhere close, I would underwrite it because it really depends on your expense ratio. And that can vary a lot, especially for this deal. With the residents paying all utilities, our expense ratio is much lower than 50% on this deal. So, a 1.25 expense ratio is great. So I'll look at, the purchase price per door, the asking price per door, and then I look at the current rents. And I can just kind of, once you've looked at enough of them, you can tell it's kind of like all these sniff tests rolled in together. You can just kind of tell, well, it meets this, it meets this, it meets this. So, at that point, I would do a deeper underwriting to make sure, and stress test it heavily to make sure the break-even occupancy is where I want it to be and that our returns are there that we expect.
And then so you said you're able to take this from 700 to 850 without any renovations. Is that the business plan, or are you planning to still renovate the units and get higher rental premiums?
We actually are. We're still renovating the units, and most people would say that if you're not getting a return on investment on your rehab dollars, you shouldn't do it. You shouldn't over improve, and I agree. But at the same time, we're focusing on tenant retention. We want these people, we want to attract a high class of resident that are going to stay a long time. We want to make it a nice place. And there's some rehab items that we're doing that it's not necessarily for the rent bump because we know we can get $850 anyway. But it's also for the long-term maintenance. We want to reduce our long-term maintenance expense. So, instead of leaving this old commercial carpet that's currently in the units, we're going in with the luxury vinyl, the LVT for longevity reasons, not necessarily for a rent bump. But we are planning to test the market at 900 rather than 850.
And then so resident retention. On larger properties, you can have amenities such as like courtyards, dog parks, playgrounds, things like that. On a 30 or 40 unit property, what are some things that you do to create a sense of community?
So we actually have a little common area on one little corner of the property where it almost looks like a building could be built there. So we've kind of toyed around with in the future, what could we do with that space? Like we could probably build more units on it. Or we could do some type, or we could do some type of like amenity. So we're just kind of watching the market, kind of see what direction we want to go with that space. And one thing we thought of, there's actually a property right next door to the subject property that is another 20 to 25 units. Can't remember the exact. But we thought if we can get that, and we're already working on trying to get that property, and then we have like two real close together side by side, then at that time it would make more sense. If we don't want to build, then at that time we could add an amenity, and then we have more units that could share that amenity. Because right now, to build a playground or a dog park, maybe a dog park might be worth it, but we don't accept pets at this property, so that's kind of out.
Right.
If we built a playground only for 30 units, like how many of our residents have kids, or would we attract residents? It's just kind of would we really see the benefit of it with only 30 units? So we think we'd need a few more units to try to add the amenity right now.
So that like sub 100 unit class, is that kind of like your wheelhouse? Is there anything you like about that space, or are you looking to scale up and acquire larger properties?
We've been looking at anything between 20 units and 200 units. I just haven't found anything in the 100 plus yet that makes sense. So I just found that the sub 100 unit properties, you can just find much better deals because there's not quite as much competition in that space. And then also, joint ventures. I love joint ventures, and it's obviously easier with smaller properties because of the capital required. So I love joint ventures because of the flexibility and being able to work with great partners. And like I said before, with the exit strategies, you could be more flexible with that than with a syndication model and having to answer to 20 investors.
Right. Sometimes even more.
Yeah, or more.
So have you found any challenges though, managing these like sub 100 unit properties? Because once you get to 100 units, that's where it starts to make sense, where you can have like a full-time staff. But like on a 40 unit or a 30 unit, the property can't absorb like a maintenance tech or a leasing agent.
Right. So we had to get kind of creative with a 40 unit property. With the 40 unit, there's really, in Birmingham, Alabama, which is where it's located, there's really no management company for that 20 to 75 units that does a good job.
Mm-hmm.
You have your management companies for your fourplexes and single family stuff, and then your 100 plus with on-site staff. So the in-between is tricky. So what we actually did, I have a really good friend that was previously a regional for a large multifamily management company, and he had aspirations to form his own management company and do it right, basically, for that size asset class. So he kind of made that move with my property being the first one. He walked away from that job with that management company and started his own, and he's managing my property. He has a leasing agent under him that works on my property. And then what we did for maintenance, we actually had a guy he knew through his previous management job as a regional that moved in one of our units. We give him a rent concession. So we give him free rent, but he does several things for us. He does all maintenance requests without charging us, other than whatever materials we reimburse him for. But he does all work orders. He does all landscaping for the property, trimming the bushes, cutting the grass. That itself would be pretty expensive. And then he cleans our common areas once a week. And in general, he's just there on site to be able to take care of things quickly. That's important, to take care of maintenance requests quickly. So we thought that was a huge bonus having that. And so far it's worked out really well, that one. So you just have to get creative with that unit size if you don't have a management company locally that does a good job. Now with the 30 unit, we have a typical, traditional management company situation there so far. Still kind of early, to know if it's going to be a great thing or not. But so far it seems to be going well.
So have you found any ways to incorporate technology into managing these properties?
I think I already mentioned Slack. That's one thing we've done that I have found super helpful. So one thing that I noticed with my property management company on the 40 unit was driving me crazy. We'd have text messages and emails and, just there's so much communication going between all of us, whether it be our maintenance guy, our leasing agent, or our head property manager, that we all decided to get on Slack. Well, I introduced Slack to them and said, is this something that y'all would be willing to do for me to keep things a little more organized? And they were on board. So we started a Slack channel, and we have separate channels for each thing. Like we have a leasing channel, a delinquency channel to talk about, rent collections. And we have a maintenance request channel for our maintenance guy. If I know of a maintenance request, or if my leasing, we can all post in there. If a resident, maybe it's not something a resident's put in officially, but something we notice. And then we also have a rehab channel where we all talk about the progress being made on the units and coordinate dates. So that's helped a ton. And we have a Buildium channel. So if I use the card for something, I can post in there and make sure that they put it in Buildium, our management software, or they can as well. So that's one software I've used that I've found very helpful.
What about with leasing your units during COVID-19?
We've actually seen an increase in leasing, surprisingly. I really thought we'd have issues leasing, but we've signed more new leases in the last month than we signed in the last 3 months before that. So I don't know. People are moving. One thing I noticed, because sometimes I look at the applications on our management software for fun, because I just kind of like to see what kind of applications we're getting. And I've noticed we've had a few here lately that, there's a blank on there for reason for leaving your past, residence. And I've seen some people putting separation as the reason, like, divorce is coming, they're separating. So I think it's just kind of a situation where people have been stuck with their significant other for several months, and some of them just, it's kind of causing people to split up and causing people to move, whereas they otherwise might not have. So I don't know how long that's going to last, but so far it's actually caused an increase in traffic for us.
That's really interesting. I haven't heard of that at all. I wonder if there's any data on that at all.
Maybe it's just Birmingham. I don't know.
I mean, it makes sense. Yeah. So are you still having someone open the doors and show them the units in person, or have you gone virtual at all with that?
We haven't gone virtual with showings. I mean, we've gone virtual with signing leases and other documents, but as far as showings, our maintenance guy lives on site. So he's able to go over there and unlock the door for them. And he doesn't like go in with them, but he can be there when they get there to see the unit and then open the door and let them walk in and see it and then lock up after them. So, virtual is great, but it's not really something that we've tried out. Since we have them on site, it's pretty easy.
That's awesome. Okay. So I wanted to get to our section of the show that we call the Fast Five, or the same 5 questions we ask every guest that comes on the show. And if you're ready, we will get right into it.
Okay. Yeah.
All right. So question number 1, if you were in your early 20s and you had to start all over again, how would you do that?
Well, I would definitely say don't have analysis paralysis and just jump in and do a deal faster than you probably otherwise would, because you learn the most by doing. Like, it doesn't matter how many books you read or how much you practice underwriting or practice assuming you're going to do a deal eventually. Just go ahead and do it, because obviously don't make a bad mistake or don't overpay, but make sure you have that educational component behind you. But once you do, just jump in and do a deal, because that's what it took for me to really get that confidence to move forward with other deals.
Yeah, you're speaking straight to me.
Go buy a deal.
All right. So question number 2, how do you see young professionals adding the most value to experienced operators in this space?
It all depends on what your superpower is or what you're good at. So that answer would be different for different people. For me, I love underwriting. I love asset management. I'm focused on systems, and I'm that analytical mind. So for me, I always offer with more experienced operators to be boots on the ground. If you have a property in this area, I would love to help you out with the asset management piece and, with overseeing contractors. But, maybe you're a people person and you love to raise capital and you love to bring people together to benefit each. Maybe you like the investor relations piece, and that would be something you could offer to a more experienced operator.
That's an amazing answer, I think. Yeah, leveraging your strengths.
Right, exactly.
So question number 3 is, what's the biggest mistake you've made in your business or in your career, and how have you since adjusted from that?
I would say the biggest mistake I've made is not vetting partners properly. I won't say which deal, but there was a deal when I first started early on that I didn't vet partners as well as I should have. It all turned out well, but it was more luck for me that it all turned out great. But I could have seen that going badly. So moving forward, I'm definitely a lot more careful about who I partner with, make sure that our visions align, our goals align, and we're all on the same page and all want the same end goal.
Question number 4 is, what's been your favorite way to incorporate technology and social media into your business? I know you touched on this a little bit earlier.
Yeah, I would, same answer as before. Slack's been great for us. We tried Trello and some of the other project management type softwares, but since we don't have like a big team of, for project management, I kind of avoided that. We're not using it, but for bigger projects, I absolutely would incorporate that as well. And then, analyzing software like your analyzer, that's been huge for me and helped save me a lot of time. And as far as social media, I could do a lot better with that. I'm not big, I'll post every blue moon, but I definitely need to try to do a better job of getting out there on social media.
And then last question is, what book has been most influential to you just along your journey?
One book that has really just stuck out for me, I could name a bunch of multifamily books, but I'm sure we all know those, but Never Split the Difference by Chris Voss. That book, it's not just about negotiating. I mean, it is, but it isn't. It's more just about, to me, my takeaway was more just about, mind games isn't really the right word, but it's just learning how people think and react to other people was big for me, and it's kind of changed the way I interact with people. And, I'll stop and think before I answer sometimes, especially in any type of negotiation, but also in everyday life. So I love that book. I need to read it again. That reminds me. Every time I read it, I get more from it. It's one of those books you can just keep reading. So Definitely recommend that one.
I read that one every year because he just has so many amazing tips and tactics in it. And I pick something up every time I read it.
Yep. It saved me a lot of money too with contractors.
Awesome. All right. Well, Candace, thank you so much for joining us today on today's episode of the Millennials and Multifamily podcast. If any of our listeners wanted to reach out and get in touch with you, what would be the best way for them to do that?
You can reach out to me directly on Facebook, Candace Pilgrim on Facebook. Feel free to send me a friend request as well.
Mm-hmm.
And then my email is Candace, CANDACE, @ApolloCapitalInvestments.com. You can also email me anytime. And if anybody needs help with anything, please feel free to reach out, especially in the Alabama market.
Awesome. Well, thank you so much, Candace.
Thank you for having me on. It was fun.
Thank you for listening to the Millennials in Multifamily podcast, brought to you by Kronos Investment Partners. If you enjoyed the show, please leave us a rating and a written review at iTunes so that we can connect with more people. Finally, head on over to kronosinvestmentpartners.com and sign up for our newsletter so you can stay updated on everything we're doing. If you're interested in partnering with us as we find new opportunities, you can also schedule a phone call with us under the Contact Us tab at kronosinvestmentpartners.com.